Hello and welcome to traders and investors. I'm glad to present to you the daily market review prepared by experts and analysts of fx.co portal. Here we go. Today is February 3 and we're ready to sum up some results from ECB and the third meeting. Irina Monzenko will help us with this. The European Central Bank increased the interest rates by 50 points at this year's first meeting, while announcing a 50-point hike at the next meeting in March. Despite such hawkish results of the February meeting, the euro came under pressure. The single currency retreated from a multi-month price peak, 1.1034, and returned to the area of the ninth figure. Anomalous at the first glance, market reaction is due to several factors. If you assess the February meetings of the Federal Reserve, Bank of England and ECB, you can take note of one general characteristic. On the one hand, central banks declared the continuation of a hawkish course, but on the other hand, they made it clear that aggressive monetary policies are coming to an end. That's why the dollar was under attack at the end of the third meeting, the pound was under pressure by the end of the Bank of England meeting, and the euro was losing ground by the results of the ECB meeting. At the same time, traders actually ignored the fact that the central banks announced further steps to monetary tightening. For example, ECB President Christine Lagarde, without any vogue wording, which is considered straightforward, announced that the ECB intends to raise interest rates by another 50 basis points during the next meeting in March. According to her, the disinflationary process hadn't begun, despite the slowdown in the overall consumer price index. It would seem that such straightforward hawkish verbal signals should have served as a springboard for the euro. But instead of growth to the resistance level of 1.1090, the upper line of the Bollinger Bands indicator on the weekly chart, the price turned 180 degrees and was marked in the area of the 8th figure, followed by the retreat to the area of the 9th price level. Lagarde, while announcing monetary tightening in March, questioned the further growth of interest rates. At the same time, market expectations are more hawkish. The assumed scenario includes a 50-point hike in March and a 25-point increase at the next meeting by 50 points according to some other analysts. The single currency was under pressure as traders took the ECB's message as a sign that the central bank nears the end of its rate hike cycle. Secondly, the ECB had emphasized her stance on problematic aspects. In particular, she said that economic activity in the European region has slowed down noticeably. Nevertheless, despite the euro's negative response, the euro-dollar pair did not collapse in the area of 7-6 figures, but only retreated from the multi-month price high to the base of the 9th price level. The underlying reason for such stress tolerance is that Lagarde tried to maintain a balance in her rhetoric. Moreover, according to forecasts, the economy will show signs of recovery in the coming quarters. At the same time, the ECB had pointed to the optimism of entrepreneurs, obviously referring to the PMI and IFO indices, stable gas supplies to Europe, and reduced interruptions. Following the third and ECB meetings, the pair remained in the 1.0850 and 1.0970 range, within which it has been trading for several weeks. In the mid-term perspective, the pair will fluctuate in the given price range, alternatively pushing back from its limits, reacting to the current information flow. It's time for GBP USD pair. Jakub Nowak reports. Pound tested 1.2364 when the MACD line was just starting to move below zero, which was a pretty good signal to sell. This resulted in a decrease of about 30 pips. Meanwhile, buying on a rebound from 1.2329 led to losses because the price did not go up. No other signals appeared for the rest of the day. The outcome of the Bank of England meeting yesterday was unexpected because after the bank raised interest rates by 50 basis points, they announced that they are no longer going to proceed with an aggressive policy. This resulted in a sharp decline in pound. Most likely, this momentum will continue today as ahead are PMI data in the UK, which could put further pressure in demand, especially if it indicates a decline in the figures. Then, a speech from Bank of England MPC member Hugh Peel and talks of a softer approach to future policy will lead to an even bigger drop in the currency. However, this could change in the afternoon with the release of the much more important US non-farm payrolls report for January. A sharp slowdown in new job growth could lead to a fall in dollar demand and consequently a rise in pound. Service and composite PMI data in the US will be of little interest. For long positions, you can buy pound when the quote reaches 1.2240 and take profit at the price of 1.2295. Growth will be possible if the UK publishes very strong PMI data. However, make sure that when buying the MACD line is above zero or is starting to rise from it. Pound can be bought at 1.2210, but the MACD line should be in an oversold area, as only by that will the market reverse to 1.2240 and 1.2295. For short positions, you can sell pound when the quote reaches 1.2210 and take profit at the price of 1.2161. Pressure will return if the UK releases weak economic statistics. The breakdown of yesterday's low could also prompt a price decrease. However, when selling, make sure that the MACD line is below zero or is starting to move down from it. Pound could also be sold at 1.2240, but the MACD line should be in the overbought area, as only by that will the market reverse to 1.2210 and 1.2161. Here's medium-term trading plan for Euro-Dollar pair by Oscar Tone. Euro-Dollar rose through 1.1025 post FOMC's decision on Wednesday only to find resistance. In less than 24 hours, the single currency pair slipped back below the 1.0900 handle, giving away all gains. This was expected as per the wave structure, and meaningful retracement should be on its way going forward. Ideally, the 1.1025 resistance should hold well for the month of February. Euro-Dollar pair has now potentially confirmed a top at 1.1025 and has carved an engulfing bearish pattern on the daily chart. The larger degree wave structure, which began from 0.9535 in September 2022, looks complete now. A corrective drop should be seen breaking below the 1.0481 initial support in the next few trading sessions. EUR USD's potential to drop remains up to 1.0100, which is marked by a rectangle on the daily chart. also note that the Fibonacci 61% retracement of the entire rally between 0.9535 and 1.1025 is seen passing through 1.0100. A high probability remains for bullish reversal if prices drop through these levels. We've got an intraday trading plan for gold by Petar Yakimovic. Gold has been trading inside of the intraday trading range, which is the sign the indecision and the potential for the breakout mode. Due to the strong upside long-term trend in the background and rejection from the support zone, there is potential for the further growth. Watch for the potential buying opportunities with the upside objectives at 1917 and 1945. Stochastic oscillator is showing fresh upside momentum from the oversold condition, which is a strong sign that buyers are in control. Key support is set at the price of 1910. And finally, here's Laurie Bailey with USD GPY pair forecast. The Japanese yen got a little stronger after the meetings of the three major central banks, but it only strengthened the neutral position and uncertainty, since it's technically staying between the two lines of the price channel at 127.30 and 129.97. The signal line of the Marlin oscillator is in the negative zone, but it has not yet reached the bottom of its own ascending channel. Considering the fact that the dollar has been rising against European currencies and the stock market is also rising, we believe that the price will climb above the resistance of 129.97. Then the price may overcome the resistance of the MACD line 131.72. And logically, the breakthrough will end by reaching the resistance of 133.74. The alternative scenario assumes overcoming the support at 127.30 and falling further the underlying price channel line at 124.10. On the 4-hour chart, the price is consolidating under the balance red line on graphic and the MACD indicator line, blue line on graphic. The Marlin oscillator is rising in the territory of the downtrend with the possible intention to move to the green zone. Let's wait for the resolution of the uncertainty when the US employment data comes out this evening. That's all for today. Good luck and see you soon.